Let me start off with the first slide and talk a bit about asset class performance so far this year. Now, the market impact of the coronavirus has been severe. If you look at the left-hand side of the charts, all the bars pointing downwards, they're the various stock markets around the world, and they've all sold off clearly. The mirror image of the various bars pointing upwards on the right-hand side, they're basically the government and bond investments that investors have perceived as even remotely secure. But let's talk about equities first. The global stock market is down about 30% for the year now, and the US is officially in a bear market. What started out as an Asian concern is now very much a global one, with all countries impacted by the spread of the virus. No stock market has been spared, with the different geographies all significantly down for the year now. European stocks in particular have been the hardest hit. They've not been able to control the spread of the virus in the same way as some Asian countries. Also, while the European Central Bank has been very aggressive with quantitative easing, there's still concerns around the ability of the different European countries to coordinate a fiscal response. Interestingly, the Asian markets, although they're still negative, they've actually performed less bad than the Western ones. And this could be because of a combination of different factors. Firstly, Asia is arguably further ahead of the curve in terms of the spread and management of the virus because they started a few months earlier before the West. Secondly, the policy response in Asia has been aggressive to try and rescue these economies. And last but not least, there's actually lots of structural things to continue to like about Asian markets, and investors are probably recognizing this, but I'll talk more about this later on. On the flip side, supposed safe haven government bonds have done very well this year. For example, the 10-year US Treasury bond is up about 15% for the year now, and all this has been because investors have fled into supposed safe haven assets. But this means that the yields or interest available in these instruments are now even lower than they were before. Let me just move to the next slide. So market psychology is set up like a weighing scale, and I just want to talk a bit about this because this is important. On one hand, investors are just fearful about the world that we live in today. The virus is clearly a very scary thing with serious humanitarian implications. And from a financial market perspective, it's scary because it's very difficult to predict or forecast. And markets just don't like something that they cannot forecast. We saw this in the global financial crisis, for example. Now, on the other hand, you've got the measures that authorities are taking to manage the crisis. And the response has been very significant so far, with central banks around the world that are either cutting interest rates to zero or close to zero, and in some cases, they're relaunching quantitative easing. And further to this, governments have all delivered a series of aggressive fiscal packages to try to keep businesses and the consumer alive during this tough time. The question is, which one is going to tip the balance? Let's go to the next slide. So we've prepared 4 themes to help you navigate the volatility that we are seeing in the markets. I want to jump straight into the first theme. Unfortunately, at the moment, fear is winning, simply because the implications of new developments are not clear and the instinctive reaction is to sell. So please take a breath and don't panic. One of the worst things you could do now when everything has come down already is to sell everything. If you suffered large losses, you'll be doing the opposite of buying low and selling high. You're effectively selling low, and that's not a good thing for your portfolio. It's difficult to predict the bottom of the market. By definition, during volatile times, the swings downwards and upwards, they're larger than normal. So it can be harmful to your portfolio if you miss the large rebounds that you typically see after a sell-off. The chart that you have here on the screen shows how getting market timing wrong can really harm your portfolio. Now, on this slide, I've chosen the decade from 2004 to 2014 because I wanted to capture the volatility from 2 volatile events, the global financial crisis and the European debt crisis. And over this period, if you had resisted the temptation to sell, if you didn't touch your portfolio, you actually did very well. The leftmost bar shows you would have made almost 8% per year, even though there were significant crises during this time. The rightmost bar shows if you sold at the wrong time, particularly at the bottom of the market, and you missed just the top 20 performing days over the decade, your portfolio would have lost almost 2% per year. Now that's a very big difference in outcomes. So the key message here is don't time the market. Instead, it's time in the market that matters for your strategic investments. I'll go to the next slide. Prepare for volatility. On this chart, I've showed the VIX, which is basically implied volatility on the US stock market, the S&P 500, and you can immediately see that the volatility we're seeing in markets is similar to the volatility that we saw in the global financial crisis. So it's pretty real and pretty serious. Now, I talked about how important it is to stay invested, and I stress we still like the prospects of equities for the long-term investor. Now, that hasn't changed. But we do expect volatility to persist from here on, and markets to continue to seesaw in the short term. Hence, we've made some changes to our investment views over the next 3 months. Firstly, we've downgraded global equities to neutral from overweight. And like I said, we still think that equities are an attractive investment over the long term, but caution is warranted right now. I stress this is a modest reduction and it's not a call to sell everything. Instead, we're upgrading investment-grade corporate bonds to neutral from underweight. Corporate bonds are now cheaper and they're more attractive after the sell-off. I want to stress that corporate bonds are not true safe haven investments because they're still sensitive to the weaknesses in the economy. But the yields or interest of these investments, they're now more attractive and they do offer some diversification benefits to equities because they are more defensive. But please don't buy them thinking they're safe haven investments. They're actually not. Let's go to the next slide. Look for smart ways to diversify your portfolio. Investors should optimize their portfolios. High quality bonds, a mix of high quality government and corporate bonds should be included. Even though bonds issued by governments like the US, they're even more expensive than before now. But even though they are expensive, they're still worth including as a form of insurance against volatility. But the key thing here is to make sure you've got the right level of diversification in portfolios. The traditional multi-asset strategy, where the risk management is handled by the professionals, is a sound investment. And finally, let's move on to the last slide. Consider opportunities for the long term. This is important. With uncertainty comes opportunity, and the stock market is now actually cheaper than it was a few months ago. It's very easy to succumb to fear and to sell everything. But instead, consider the investments that are structurally attractive, but maybe just a few months ago you felt were just a bit too expensive, because these investments are almost certainly cheaper right now, and they've all fallen about 20 to 30% since the start of the year. Having said that, we're not advocating buying everything out there. It's still important to be selective. For example, even though European equities suffered the most, down more than 30%, we still don't like it compared to other options because these markets have less ammunition from a policy perspective. Europe's interest rates were already negative before the crisis, and they were already doing quantitative easing. This means it's less clear whether more monetary policy measures will be effective. Also, there are doubts as to whether they'll be able to sufficiently coordinate a fiscal response to manage the crisis. We like emerging markets equities for a long-term investment compared to developed markets, particularly in Asia. Asian authorities have taken aggressive monetary and fiscal action to combat economic weakness. And actually for these markets, lower oil prices are a good thing for them. Emerging markets valuations, whether you look at price to book or price to earnings ratios, they're cheaper today compared to their 10-year averages. Now, for example, in EM, emerging markets, price to earnings ratio is about 11.4 times compared to their long-term average of 11.6 times. And it's the same thing for price to book, at 1.4 times compared to their long-term average of 1.5 times. Asia also had to confront the coronavirus outbreak before the rest of the world, and is arguably closer to returning to some semblance of normality than the developed markets. Now, this can only be a boon to their economy, and it'd be positive for EM and Asian investments. I just want to talk a bit about sectors for a moment. Now, from a sectorial point of view, it's worth mentioning that during this volatile period, the sectors most exposed to the sell-off have actually been the usual suspects. Your banks, your insurance companies, your industrials, in other words, those sectors most exposed to the risks in the global economy. The sectors that have been most defensive during this period have been the ones like the food producers, the utilities, your pharmaceuticals. In other words, those that are least exposed to the risks in the economy. These are the sectors that have a captive business regardless of what happens. Everyone needs food, everyone needs electricity, and everyone needs medicine. There are a few sectors which have been quite uncorrelated to the volatility, and it's these sectors where fund managers can cherry-pick their individual success stories. Technology is the obvious one here, where some companies have done quite well actually during this volatile time. For example, those technology companies that provide remote working or communications technologies, they've actually done well. And communications technologies like the one we're using right now, it's a service obviously in high demand when everybody is staying home.